Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, the Guardian and the Challenger go head-to-head on 4.55% risk-free. Why cash savers are having the last laugh in 2026. Let's get into it.
Let me start with a simple fact. Cash savings accounts are paying 4.55% right now with absolutely zero risk of capital loss, and the FTSE 100 has dropped 5.6% from its February peak. If you held £20,000 in the best easy access account since January, you've earned roughly £225 in guaranteed interest, while equity investors watched £1,120 evaporate.
And if you'd held that same money in cash for the last decade instead of stocks, you'd have barely kept pace with inflation. £10,000 in a FTSE 100 tracker 10 years ago would be worth over £21,000 today. With dividends reinvested, cash gave you maybe £11,500.
Sure, but you're cherry-picking a decade that included one of the longest bull markets in history. People don't invest in hindsight, they invest with real money, real fear, and real bills to pay.
I'm not cherry-picking, I'm showing you what compound growth actually does over time. That's the whole point. Cash looks safe year by year, but over a decade it quietly destroys your purchasing power.
Destroys your purchasing power? Inflation is running at 2.8% and my cash is earning 4.55%. That's a real return of over 1.7% with zero volatility. When was the last time stocks gave you that kind of certainty?
But that 4.55% won't last. That's the secret tax on cash reinvestment risk. When rates fall, and they will, you'll be rolling your savings into worse and worse deals. Stock dividends, on the other hand, tend to grow over time.
You say rates will fall, but that's speculation. The Bank of England is at 4.5%, inflation is sticky, and there's no guarantee of rapid cuts. Meanwhile, my return is locked in today.
It's not locked in though, is it? Easy access means the bank can cut your rate tomorrow. And even fixed rates are only fixed for a year or two. The FTSE 100 is yielding around 3.6% in dividends alone, and those dividends have grown decade after decade.
Dividends that can be cut at any time. Ask anyone who held bank shares in 2008 or BP after the oil spill how reliable those dividend payments were.
Individual shares, yes. But a diversified tracker spreads that risk across 100 companies. Some cut, others raise. The index dividend has been remarkably resilient over any 10-year period you care to name.
Let's talk about what's happening right now though. We've got trade wars, tariffs, geopolitical uncertainty everywhere. The FTSE dropped 5.6% in weeks. There's something to be said for sleeping well at night.
And that's exactly when the best returns are made, when everyone else is terrified. Buying during uncertainty is how you get those 10-year doubles I mentioned. If you wait for calm seas, you've already missed the boat.
That sounds great in a textbook. But real people have mortgages, emergency funds, and finite timelines. Not everyone can afford to watch their portfolio drop 20% and shrug it off.
I completely agree, and I'd never tell someone to put their emergency fund in stocks. But we're not talking about emergency funds. We're talking about the millions of people sitting on tens of thousands in cash because they're scared of markets, losing a fortune in opportunity cost.
There's another angle the stock market crowd always ignores, the personal savings allowance. Basic rate taxpayers can earn £1,000 in savings interest completely tax-free. That's incredibly efficient for cash holdings.
Fair point, but £1,000 tax-free on 4.55% means roughly £22,000 before you start paying tax. Anything beyond that and you're handing HMRC a cut. Meanwhile, you can shelter £20,000 a year in a stocks and shares ISA with no tax on gains or dividends ever.
You can put that same £20,000 in a cash ISA and earn 4.55% tax-free with no risk at all. The ISA wrapper works both ways.
It does, but over 20 years that cash ISA might double your money. A stocks and shares ISA has historically quadrupled it. You're using the same tax shelter to protect a fraction of the return.
Historically. That word is doing a lot of heavy lifting. Past performance doesn't guarantee future returns. Isn't that literally printed on every investment product?
It is, and it's important. But there's no 20-year period in modern UK market history where a diversified equity tracker lost money with dividends reinvested. Not one. Cash can't say the same about beating inflation over those same periods.
But people don't behave like robots. They panic sell at the bottom and buy at the top. The average investor's actual return is far worse than the index return because of behavioral mistakes.
Now that's a genuinely strong argument. But the solution isn't to avoid stocks, it's to set up a monthly direct debit into a tracker fund and never look at it. Automate the discipline. The behavioral problem is solvable.
You make it sound so easy. But when you see your portfolio down 15% and the news is full of recession talk, that direct debit feels very hard to maintain.
Which is exactly why I'd say keep 6 months of expenses in cash, absolutely. But everything beyond that emergency buffer, it should be working harder for you than 4.55%.
We actually agree on more than you'd think. I'm not saying put everything in cash forever. I'm saying right now, today, with rates at 4.55% and markets wobbling, there's nothing wrong with being heavily in cash while you wait for clarity.
And that's where we differ, because waiting for clarity is just market timing with a nicer name. Clarity never arrives with a bell. By the time things feel safe, the recovery has already happened.
I'll take my guaranteed for 0.55% and a good night's sleep, thank you.
And in 10 years, when my portfolio has compounded past yours, I hope you'll remember this conversation.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.